Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be walking you through how I am viewing the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, as usual, kicking off with the major equity indices. We have seen a lot of consolidation lately, but it's consolidation at key levels. So are we going to get a breakout or breakdown? Not too sure, but let's take a look at the chart anyway. From there, moving on to fixed income and commodities, we'll also take a look at the sector rotational model to highlight which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest for you today, and we'll end today's session with some bullish and bearish market observations. So starting off here with the S&P 500, using the SPY ETF, and we can see the consolidation that I was talking about over the last few days. It is happening at a key level between the 410 and 420 major area of resistance. 420 is also the 23.6 fib level, so you can see that that is definitely a key level. Also on the weekly time frame, where price has struggled to really break above it, and even when it did break above it, that wasn't a sustained break, and we eventually got a break back below a few months ago. So overall here for the S&P 500, still, there's a lot of ambiguity with markets. I think markets right now are digesting a lot of the earnings announcements. We do have Amazon and Google reporting at the closing bell this evening or so. So that could generate some volatility, and that could actually provide a either a catalyst for breakdown or a catalyst for a breakout. So let's see what happens until then. But right now, I think this is more of a week for taking profits or cutting out losses. It's more of a week maybe just sitting on your hands and waiting to see which direction the market really heads in, because right now there is still a lot of ambiguity. And don't get me wrong, we did head to this area with a lot of bullish momentum, a lot of bullish sentiment, but that seems to be shifting slightly, just slightly, as we kind of go through earnings season. I wouldn't say it's a major shift or anything like that, but for now, right now trading conditions are still quite neutral, at least on the daily time frame. So until we get a bit more of a clearer picture, I don't think it makes too much sense to be trading that much, at least in the short term. Moving on to the NASDAQ 100, using the QQQ ETF, we can see that the consolidation has actually happened for a bit longer here for the NASDAQ 100. Price running into that resistance area at 320 or so, between 315 and 320. And right now, testing the bottom part of this intraday support. So we can see price is clearly finding a minor support level at around 315, set to open lower this morning, the last time I checked, but still maintaining that bullish structure. Risk to reward, in this case, still favors the upside, in my opinion, especially after a very strong move higher, breaking out to a new higher high. Yes, we are seeing some consolidation, but again, it's very similar to the S&P, where markets are still digesting a lot of the earnings announcements. Big tech earnings are yet to be released. That is going to be a huge volatility event here for the NASDAQ 100. So again, maybe a bit of patience is required. The important thing to note is that price is still finding support at 315. If there's a breakdown below this level, and a close below this level, maybe near 310, I would say we could be in the cards for the retest of 300. But for now, still no sign of that. But keep an eye out for this evening's earnings announcement. All right, taking a look here at small caps using the IWM Russell 2000 ETF. When it comes to small caps, we've spoken about the key fib levels and how prices certainly respected those key fib levels. Even just recently, we saw a breakout. We saw a nice pullback to retest that 188.38.2 fib level. Price was bouncing above it initially. And then we had the banking turmoil, which immediately saw price decline all the way to the 50% fib level, almost exactly. Since then, price has managed to stay above it, has never closed below it in the last couple of weeks. and we have seen a move higher, but not with a lot of momentum. As you can see on the daily time frame, momentum is still negative. So even though we are seeing the move higher, there's a lot of choppiness in the price action, lack of momentum, and already running into resistance at 180. Also the 55-day exponential moving average. So it's at the area between the 21 and 55-day EMA, showing bearish price action at the open so far this morning. If anything, I would say I'm short-term bearish here on the Russell 2000. I think there is potential for a retest of this 170 key level for the short term. Over the medium to longer term, though, I mean, the 50% fib level is clearly a strong area. And even if price breaks below 170, we have the 163 major support level as well to contend with. So small caps definitely at the bottom part of the range. Two major support levels that are going to be holding price up. So the risk to reward to the medium to longer term does favor the upside. However, in the short term, we are seeing that lack of momentum, and that lack of momentum at this 180 resistance area does indicate a decline lower here, especially with the bearish price action that we're seeing. And I'll be looking at a short-term move to 170 here for small caps. But overall, small caps still underperforming the large cap names. Okay, TLT, the Treasury bond ETF, and last time we spoke about the 104 minor support level, clearly acting as a strong area of support for this range-bound movement over the last few weeks. That support level used to be at 100, but now that we have a bit more clarity with what the Fed is going to be doing, we have seen TLT actually have a bit more momentum turning positive here, and finding a new range. Although the resistance level is still the same at 108, just goes to show how strong of a resistance zone that is. The support level has been moved higher to 104, and risk to reward here does favor the upside nicely. This is what I mentioned the last time we spoke, was to play this range between 104 and 108. Credit spreads would be an ideal way to do it, in my opinion, because yes, even though I am expecting to move back to 108, it's still a fairly limited move. So you want to have an option strategy that makes the most out of it, as opposed to something like a debit spread or simply buying a call that requires a large move in your favor for it to be profitable. Credit spreads are a lot more forgiving and have time decay working in your favor. So in this case, I do expect this for TLT to move higher, back towards that 108 area. And we could run into some resistance once again. I mean, the risk to reward at 108 does favor the downside, but it's all about playing the range here for TLT. I mean, TLT has been bread and butter really over the last few months, with 108 acting as a resistance level. So let's see if that can continue over the next few months. Right, moving on to the US dollar, we can see here the price is still on a strong bearish trend, albeit price action is quite choppy. We are seeing a fairly systemic move lower, breaking below that 102 area. And this area between 100 and 102 is the area of support that I'm seeing. So it's a fairly large area of support, but it is a major area of support. 100 being a strong psychological level, and 102, between 101 and 102, clearly finding support over the last, at multiple occasions, even on the weekly time frame. 2022 in June, we saw price lines of support there. So price is at a very, I don't want to say ambiguous area, because it is an area of support, but it's not really showing that bullish price action that we're seeing from this area of support to warrant a move higher. If anything, we could be in store for more consolidation or a shorter term decline back down to 100. Should we see price reach the 100 level, we will then reassess from there. But for now, the dollar definitely on the back foot, but not declining with a lot of bearish momentum. All right, moving on to gold. So gold, remember, moves inverse with the dollar. It is also a safe haven. So during the banking turmoil, we saw a huge move higher here for gold, very similar to that of what happened in, sorry. Let me get that back. Sorry about that. There we go. So similar to the move that we saw in November, we're seeing that move in the last few weeks as well, followed by a small pullback, very limited pullback, and price staying above that 21-day exponential moving average. So that just speaks to the amount of momentum that gold had. And also, in the case here for gold over the last few weeks, it was able to stay above the 21-day exponential moving average. However, if you take a look at the price action over the last few days, clearly we are seeing a decline in momentum, followed by price grinding lower, finding some intraday support at around 183, 184. But that support level, in my opinion, is weakening. We are seeing price actually open below that support level. And if we get a close below that support level, that could be a sign for a further decline here, potentially back to 180 or even 177. So gold, and it's just looking like it is running out of momentum. However, I don't view this as a reversal yet, because if you look at the bigger picture on the weekly time frame, we can see there's a lot of momentum here in gold, right? Really strong move, followed by a pullback, followed by another strong move higher. Yes, there are some rejections at 190, but it hasn't quite reached at 192, 193 area. That was my overall upside target here for gold over the last few months. And I still think that there is, at least on the daily time frame, there is potential for another bullish leg higher, and we could see price hitting that 192, 193 level and posting what is going to be a major triple top. So let's see what happens with gold, but right now momentum is definitely declining. Oil, so looking at the light crude oil futures, we can see that price is struggling at 81. That is a key resistance level after the gap up higher due to fundamental reasons, really, with Japan going against the sanction of purchasing, or being given the green light to go against the sanction of purchasing Russian oil above $60 a barrel. That did see a price jump higher, as well as the OPEC cut. So those two factors saw price jump up. And it looked like it was going to be carrying a lot of momentum heading into this 81 area of resistance. We got a false breakout there. Price immediately reversed lower, finding some support at the 55-day exponential moving average. I do not believe that is a strong area of support. And the bearish price action so far this morning somewhat agrees with that. So we can see here that after this move lower, price has been popping up a little bit higher in the last 2 days, but we could be in store for another leg lower here. And I'll be targeting 72.50 or 70, that range, as a potential downside here for oil. Now, when you look at oil, you immediately want to think of the oil companies that have high exposure to oil prices. So this does provide a nice short-term risk to reward bearish opportunity for energy companies and oil companies. So that's how you would want to look at, that's why you would look at the oil charts when it comes to trading. All right, moving on to sector rotation. We have 5 sectors in the improving and leading category, and we have 6 in the lagging and weakening category. Now, in the leading category, we have technology and communications. Now, both of these sectors are seeing a bit of outward rotation, and that just, that's quite natural. I mean, they were providing leadership for quite a few weeks, and now we are seeing a lack of momentum there and a bit of outward rotation. So I don't know if they will be rotating into the weakening category. I think we need a few more weeks of bearish price action, because when you look at the charts for communications and technology, they're not exactly bearish. So even though they are losing out on a relative perspective, that just has to do with the cyclicality of sectors and sector rotation. It's difficult to maintain leadership for an extended period of time unless we had very low interest rates like we did during the pandemic recovery period, where technology was able to provide leadership for basically a year. So until then, I wouldn't say we should be bearish on communications or technology just yet. Discretionary as well, very similar, but in the improving category, also losing out on that relative momentum. We have our defensive sectors all doing quite well. So that is an indication that investors are still a little bit uncertain as to the short-term outlook here for markets, and naturally are rotating towards the defensive sectors in utilities, in staples, and in healthcare. Utilities and staples in the improving category, and healthcare on its way into the improving category from the lagging category. We have real estate and financials continuously losing out on that, on that relative momentum and relative strength. Energy did move a little bit higher due to the move up higher for oil prices, but I don't expect that to be too sustainable. We also have industrials and materials both rotating from the weakening category and into the lagging category quite recently. Now, moving on to some subsectors of interest, and we're really going over the subsectors that we've covered the last few weeks, and starting off with IBB, which is a biotechnology ETF. Now, we are seeing a lot of rotation into healthcare, and biotech is a part of the healthcare sector. However, this was a trade that a few months ago was quite bearish, and it was a beautiful bearish trade for those of you that did tune in for my market outlooks. From the beginning of the year, I was saying that, or I'd say from February, so I was saying that IBB had a great bearish opportunity at 138 due to this area of resistance and due to the bearish price action there. And we had multiple entry points for IBB, and it pretty much hit our target almost exactly at around between 120 and 122. Since then, we saw a move up higher, and that's when I started to shift sentiment. After it broke above its 21-day exponential moving average, I was looking for a move higher, targeting two areas, 133 and 138. Now, the first target area has been hit at 133, but what we're seeing here, and it was hit quite a while ago, but what we're seeing here is a lack of momentum, really, or I should say, a lack of price action to see price breaking above that 133 level. So 133, clearly a resistance zone, price struggling to break above it, and so it makes sense for that to be the first take profit. And, if we do see a breakout the next couple of days, then 138 could be the second take profit. However, if we do not, I would say, even if you close out on half of the trade, probably close out on the second half of this trade. Again, we have to think about the bigger picture. And right now, the bigger picture when you look at the S&P, when you look at the NASDAQ, is that we do not know. It's a very ambiguous picture. We don't really know where markets are heading next, because even though there was a very bullish sentiment only a few weeks ago, as we navigate through earnings, that sentiment does seem to be reversing slightly. And that's why I said this week, again, is more for taking profits, it's more for cutting losses and really sitting on your hands, I think. Now, the home builder ETF, another great bullish trade idea for us that worked out quite well, because we were looking at 64 as a minor area of support, which was a thesis for this bullish trade, right? We were seeing bullish price action, and even quite recently, we saw that price retested there and was moving higher. That provided a nice risk to reward bullish entry point, and it has now hit our upside target of 70. It hasn't necessarily reversed from there. Yes, it is running into that resistance, consolidating a little bit, and we could actually see a breakout. But again, this is a very similar situation to the biotechnology ETF from the last slide, where you'd probably want to take half profits here, and then the next couple of days, if it doesn't break above 70, close the whole position, because this 70 level is a major area of support and a major area of resistance. We can see that in the weekly time frame that has provided support and resistance in the past. So if we don't see a breakout soon, I would consider closing out the entire position. But for now, definitely a trade that has worked well in our favor. And semiconductors. So this is where we see that rotation out of technology, right? Because even when the rest of the market is a bit more neutral, we are seeing semiconductors pretty much one of the biggest or second biggest subsectors within the technology sector. It is losing out on some steam there. Yes, price is still above that 55-day exponential moving average, set to open a little bit lower this morning, but overall, there's a severe lack of momentum. Momentum has been declining at a rapid rate. And the thesis for my bullish, my bullish thesis was due to the fact that price was staying above this 247 level. Price is now not staying above that, even though there were the last few days where it has touched the 247 level or 250 level. It hasn't really moved higher with a lot of momentum. So we're not seeing a bullish price action from a key area of support, and we are seeing price slowly grind lower. If this is a trade that you've done, I would say that now would be the time to close this trade. It's just invalidating our thesis so far. So I'm not full out reversal or bearish on semiconductors just yet, but it does look like we could see price, slowly declining below that 247, 250 area, and potentially even back down to the 230s. That would be the next key area of support here for semiconductors. Speaking of semiconductors, we have AMD. So AMD was a bullish trade based on my bullish sentiment for semiconductors and AMD being the best in class along with Nvidia in the semiconductor subsector. I thought this would be a great bullish play. Initially, it did look quite good. I mean, we saw these pullbacks providing good buying opportunities, but it hasn't quite worked out in our favor. Yes, there was some initial moves higher, but they didn't last. Momentum has been declining. And price, again, at the 55-day exponential moving average, not showing the bullish price action that you want to see. This would be a trade where we just cut losses. Unfortunately, not all trades work in our favor, and this was one of them. I thought that we could get a nice risk-reward bullish entry point for a retest of 100 and a potential breakout. So far, not turning out to be the case. I do still think in the longer term, it's only a matter of time before AMD breaks above 100, but we are seeing that momentum just isn't there right yet. All right, taking a look at lows, so part of the home builder ETF. And, this was a trade idea that's worked out quite well for us because we saw an initial move higher, followed by a pullback to the area between the 21 and 55-day exponential moving averages and some bullish price action there. A lot of intraday rejections of the 196 level. So that provided a good risk to reward bullish entry point back to this 210 area, which was our target price between 210 as the first one and 220 as the second one. It has reached our first target price. I would actually suggest closing out the entire trade. Now, we are seeing rejections at 210. Price is showing bearish price action at that level and set to open a good bit lower this morning. So, it was a trade that worked out very well. And even though there is potential for a revisit to 220, the fact that we are seeing that bearish price action at 210, or as much of it, I would look at closing this setup. Okay, moving on to Apple. Apple is a longer-term bullish play that we have had. And, well, when I say longer-term, I mean for the future, because initially we were bearish and it was working out quite well. And then we got this breakout. Breakout followed by an intraday retest provided a perfect risk-reward bullish opportunity from 155, 156, previous resistance turning support. And overall, price action is still quite bullish. Overall, still in a bullish trend. It does have earnings coming up. That's the one thing to be looking at. However, Apple, from a technical perspective, still looking quite strong for continued rally back towards our target price of 175 to 180. So moving on to IBM. So IBM, again, this is another name that we've used quite often in the last few months. Initially, I used this earlier in the year because we saw IBM have a huge bearish move, followed by a retracement higher, followed by another bearish move, but breaking below 137, which was a previous swing low, and using that 137 support, now using it as resistance, which provided another bearish entry point, and it hit our downside target of 122.50. I was looking at around 120 as a potential, so 115 as a potential downside target. So it didn't quite hit there, but it was a very good bearish, profitable trade. And then we saw a retracement higher back to 132. Now 132.50 is a previous area of support, turning resistance. So a very similar pattern emerging like we did see a few weeks ago with price breaking below that 137 level. So that's why a couple of weeks ago, I was looking at IBM as a bearish setup when I was here speaking for this market outlook. Since then, it has worked out very well in our favor. 132 acting as a bearish thesis of resistance, and we are looking at another move lower. 122.50 will be the next support level, but I still think there's potential for it to reach 115 or so. And when you look at the bigger picture, when you look at the weekly time frame, you can see that IBM has been in this range between 150 and around 115. So it hasn't quite reached that bottom part of the range just yet, and I'm looking at this move, thinking that it might potentially complete this move, the larger move, and actually retest the bottom part of this range. Okay, moving on to a new idea that I have for you today, and that is PayPal. So PayPal is actually a bullish trade, and you might be thinking, why would you do a bullish trade here on PayPal after this significant decline? Now that decline, I think that was warranted because even though PayPal's fundamentals are pretty decent actually, and it has good business prospects, PayPal was extremely overvalued, which is why we saw such a significant decline, especially when interest rates started to move higher. Now, Since then, what we've seen is price form a new area of support at between 70 and 72. And yes, overall, trend does remain quite bearish here, but we are seeing a bit of capitulation form. I mean, I don't want to say that's the inverted head and shoulders, but technically speaking, that is a higher low. Price finding some support at 72.50, and I don't necessarily expect a huge move higher, but it does provide a nice credit spread opportunity because we're using 72.50 as our thesis here as of support. And as long as price stays above it, a credit spread using a short strike of maybe 72.50 or 72 will remain profitable. So that's how I'm viewing PayPal as a bullish opportunity. It's based on the fact that 72.50 is a strong area of support. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week.